Hello students, in this video I would be discussing management accounting question paper which was asked in December 2021 exams. Fine, straight away we'll go to 61st question which is management accounting part. Yeah, come to 61 question. Which is part 2 or part B. Yeah, chalo guys. Recording of workers' time spent on different jobs or processes for determining labor cost of job or process is called time booking. It is time booking. Timekeeping is different, which is recording of attendance of employees. What time they came, what time they went. Whereas time booking is recording how much time is being spent to complete a particular job or process. Clear? Yes. Next, according to SEMA, prime cost is what? Direct material and direct labor. Actually, prime cost means direct material plus direct labor plus other direct expenses. But as per SEMA, clearly I have mentioned it in my material also. So it will be good if you guys are having even the class material with you so that you guys can refer it. So let me just come to that. Yes, Joe. Coming to cost sheet format, it includes direct material consumed or raw material consumed plus direct wages plus direct expenses. This is actual format. Yes, but as per SEMA, prime cost means only direct material and direct wages. Direct material and direct wages. Yes. Chalo. Next. And if by chance, if any problem is asked to be calculated, like what is the amount of prime cost and all, please consider other direct expenses also. Okay, this is only as per SEMA terminology. Prime cost means direct material plus direct labor. Yes, rent of own factory premises is an example of what? So if I am working in my own building for which we are considering rent, what do we call it as? Notional expenses or notional rent. Next, the aspect of material control are accounting aspect and operational aspect. Clear? Accounting aspect and operational aspect is the aspects of material control. Yes. Next, rule 6 of companies. This is a question on second chapter. Till now whatever we covered was first chapter. Rule 6 of companies cost records and audit. Rules 2014 requires the companies prescribed under the said rules to appoint an auditor within dash days of commencement of every financial year. It is 180 days. So within 180 days of commencement of a financial year, the auditor has to be appointed. That is cost auditor. Yes. Chalo. Next, the cost auditor shall submit the cost audit report along with his or its reservations or qualifications or observations or suggestions, if any, in form CRA 3. The cost auditor will submit the cost audit report to the company or board of directors. They will send a copy to the central government in CRA 4. But what are they asking here? The cost auditor, in which form will he submit the report to the company along with his opinion? It is CRA 3. CRA 3. Yes. Next, as per CCRA rules 2014, every regulated industry category A is required to maintain cost records if overall turnover exceeds or equal to. See, when it comes to maintenance of cost record, there is no categorization. It is same for everyone, whether you are regulated or non-regulated sector, the rule is same. That is, if the turnover is more than 35 crore, then they have to maintain the books of accounts. But as per the suggested answers, they have given it as 50 crore, which is not correct. Clear? So as per the suggested answers, they have given it as 50 crore, which I tell is not correct. Why? I will just show it. Come to my material, second chapter. Second chapter. Yeah. Here you can see, as per section 148 subsection 1 of the Act, the class of companies including foreign companies defined in section 242 of the Act engaged in the production of the goods or in rendering services having an overall turnover from all its products and services of rupees 35 crore or more during the immediately preceding financial year, that is last year, shall include cost records for such products or services in their books of accounts. So when it comes to books of accounts, there is no categorization, regulated what and non-regulated what and all. Yeah, that categorization is only for cost audit purpose. Yeah, so here it is clearly given. So there it is for regulated sector, it is 50 crore from all its products, and from individual product it should be more than 25 crore. Actually, they have considered this, but what the question is on not cost audit, it is on cost records. Please be careful. Yeah, yes sir. So the answer here is 35 crore, guys. Yeah, next. The requirement for cost audit rules shall not apply to a company which is covered in rule 3. Okay, that is whose revenue from exports in foreign exchange exceeds 75% of its total revenue. Yes, correct. Which is operating from a special economic zone. Correct. Which is engaged in generation of electricity for captive consumption through captive generating plant. Yes. So for all these 3 cases, cost audit is not applicable, guys. Okay, you can check it here. I have just mentioned it. Yes, see these 3 cases, the cost audit shall not apply. All these 3 scenarios are given there. So the answer is all 3. All 3. Yeah, you can also refer when I am discussing. You guys can also keep the study material with you so that you can quickly refer to and get more clarity. Next, PQR factory. So you can observe second chapter, even though it is a small chapter, still at least 3-4 questions are asked, guys, and it is very easy to score good marks with respect to this cost records and cost audit. Yeah, let us go to next question, 69. PQR factory produces 2 units of a commodity in 1 standard hour. So in 1 hour, how many units they are supposed to produce? 2 units. Okay. Actual production during the particular year is 34,000 units, and budgeted production for the year is 40,000 units. Budgeted production is like a target, what you are supposed to achieve. But what you actually achieved is 34,000. Actual hours are 16,000. That is, actual hours worked is 16,000. Activity ratio they have asked. So next, actually in the next questions, they have also asked capacity ratio, efficiency ratio, for which you require 3 information. First, let us calculate that, so that these 3 ratios we can easily calculate. What are those? Actual hours worked. It is directly given in the question, 16,000. Okay. Next, standard hours for actual output. For actual output. Actual output means how many hours you were supposed to take to produce the actual output. How many outputs you have produced? 34,000 units. So for that, how many hours you were supposed to take? So you were supposed to produce 2 units in 1 hour. So to produce 34,000 units, how many hours you were supposed to take? 34,000 divided by 2. So how much is that? 17,000 hours. 17,000 hours. What is it? Standard hours for actual output means to produce 34,000 hours, you were supposed to take how much? 17,000 hours. But how many hours you have taken? 16,000 hours. Good only. Next, budgeted hours. Budgeted hours will always be for budgeted output. What is the budgeted output? 40,000 units. So for 40,000 units, how many hours you are supposed to take? 2 units per hour means 20,000 hours. 20,000 hours. So budgeted hours is different, standard hours is different. Standard hours will always be for actual output. Okay. You are supposed to take 1 hour for 2 units. You have actually produced how much? 34,000 units. So how much hours you were supposed to take to produce actual output? 17,000 hours. Whereas budgeted hours means to produce budgeted output. What was your target? 40,000 units. To produce that, how many hours you were supposed to take? 20,000. Okay. Chalo guys. So this ratios and all is a part of your next chapter. Come to that. Activity ratio. Just a second. Let me just show it. Yeah. This one. Ratios. Control ratios calculation. So what they've actually asked, 2-3 questions are there on the same topic. First one is activity ratio. First one, what they have asked is activity ratio. So the activity ratio, the formula would be standard hours divided by budgeted hours. Standard hours means standard hours for actual output. Chalo. So here what we have to do? 17,000 divided by 20,000. 17,000 by 20,000 into 100. So this is your activity ratio. So how much is that? 17 by 20, I'm straight away doing it, into 100, 85. 85% is the answer. Next, using the information for question number 69, capacity ratio is. So they're asking you capacity ratio. So what is the formula? Actual hours worked by budgeted hours. So actual hours worked is directly given in the question. Capacity ratio is equal to actual hours worked 16,000. So 16 by 20, I'm straight away doing simplification. So 16 by 20 into 100, it is 80%. It is 80%. Okay, I have just ignored thousands. So straight away calculations I have done. Next is efficiency ratio. So what is the formula for efficiency ratio? The formula would be standard hours for actual output divided by actual hours worked. So standard hours for actual output, efficiency ratio. Standard hours for actual output is 17,000 hours. Actual hours worked is 16,000 hours into 100. So 17 by 16 into 100. It is 106.25%. So on the same question, 3 different ratios are asked in 3 different questions. So you will be getting 3 marks. Yes. Next, from the following data, volume of production is given for 2 period and maintenance expenses is given. Let us take it as period 1, period 2. Variable cost per unit, easy. How will you calculate? Change in total cost. Maintenance expenses, whatever they have given is like a total cost. Change in cost divided by change in output. So variable cost per unit will be how much, guys? Change in cost, that is 1,02,000 minus 84,000. It is 16 plus 2. It is 18,000. Change in cost. So why there will be change in cost? Due to change in volume. So how much is that? 30,000. That is 1,50,000 minus 120. So do 18,000 by 30,000. What is that? Variable cost. And variable cost is the cost which will always vary with your production. Whereas fixed cost element will be same. Whenever you are producing more, the cost will increase. That cost is only variable portion, not fixed portion. So what is the variable cost per unit? 0.6. Next question is also on the same. Using the information from question number 72, the total fixed cost. You can take any one period, period 1 or period 2. Let me take period 1. What is the total expenses? 84,000. So let me calculate. Total expenses is 84,000. From that, let me minus variable cost. How much is that? 0.6 is per unit. How many units are produced? 1,20,000 units. So how much will be the variable cost? 72,000. 72,000. So how much will be the fixed cost? 12,000. So from total maintenance expenses, I have reduced variable cost. You get what is the difference? Fixed cost. Same thing, sir. Can I take second year? Yes. Second period. How much is the total cost? 1,02,000. Okay. 1,02,000 is the total expenses. How much will be the variable? 0.6 into how many units are produced? 150. 150. So how much is that? 0.6 into 150. 90,000. So what is remaining? 12,000. What is this? Fixed cost. Because fixed cost will remain fixed from period to period. It will not change. Whereas variable cost will increase with the increase in production and it will decrease with the decrease in production. So hope you guys understood. So fixed cost is 12,000. Using the information from question number 72, what is the total variable overheads at level of output of 1,40,000 units? So if you produce 1,40,000 units, variable cost per unit will always be fixed, whereas total variable cost will increase. So 1,40,000 into 0.6, how much is that? 84,000. So the total variable expenses in maintenance expenses will be how much? 84,000 if 1,40,000 units are produced. So you can see there are, with respect to this question, 1, 2, 3. 3 questions are there. Okay. Let us go to next question, 75th. which is not a method of preparation of cash budget. So receipts and payments method is a method, adjusted profit and loss account is a method, then balance sheet method, and cash flow method is not a cash budget method. Okay, you have something called as cash flow statement separately, fund flow statement separately, but it is not a method of preparing cash budget. There are only 3 methods to prepare cash budget, which is ABC. So D is not a method to prepare cash budget. Okay, next. From the following information, calculate debtor turnover ratio. Closing debtors 2 lakh. Cash sales is 25% of credit sales. Okay. Excess of closing debtors over opening debtors is 80,000. Total sales is 20 lakh. Total sales is 20 lakh. Okay. Sorry, 12 lakh. Excess of closing debtors over opening debtors 80,000. Okay. So closing debtors is 2 lakh. Excess of closing debtors over opening debtors is 80,000, means can I tell opening debtors is 120, 1.2 lakh. Closing debtors is more than opening debtors by 80,000. So obviously opening debtors would be 1.2 lakh. Okay. Then what else is given? Calculate debtor turnover ratio. Cash sales is 25% of credit sales. Total sales is given 12 lakh. Oh, there is some twist. Cash sales, they are not given 25% of total sales. 25% of credit sales itself. Okay, we have to do some cross calculation here. So can I do this? Cash sales plus credit sales is equal to total sales. Okay, similar to cost plus profit is equal to sales calculation we will do now. Similar to that, guys. Okay, cash sales plus credit sales is equal to total sales. Okay, they have told cash sales is 25% of credit sales. So as it is given as a percentage of credit sales, let us assume credit sales as 100. So how much will be the cash sales? 25%. That is 100 into 25%, which is 25. Yes. How much will be the total sales? 125. 125. Now cash sales as a percentage of total sales, how much it will be? 25 by 125 into 100. 20%. 25 divided by 125, you will get 20%. Hope you guys understand. This is similar to the calculations which we would have done in the class also. Cash plus profit is equal to sales. Okay, if profit percentage is given on sales, how to convert it on cost? Or if profit percentage is given on cost, how to convert it on sales? We have done similar to that. Okay, here cash sales is given as a percentage of credit sales, and that credit sales we don't know. Clear? But we know total sales. So what we did, cash sales is given as a percentage of credit sales. So we assumed credit sales as 100. So how much will be the cash sales? 25% of that, which comes to 25 rupees. So what will be the total sales? Cash plus credit sales is equal to total sales. So what is cash sales as a percentage of total sales? 20%. So credit sales 80%. Because when we are calculating debtor turnover ratio and all, we require credit sales, which is 80%. 80%. In rupees, how much it will be? 12 lakh into 80%. 12 lakh into 80%. So 12 into 80%. So it is 9,60,000. 9,60,000 is a credit sales. Hope you guys are clear. Cash sales is 20% of total sales, means credit sales will be 80% of total sales. That is remaining. Okay. So what actually they have asked? From the following, calculate debtor turnover ratio. Okay. So this is a question on ratio calculations. So you can come to ratio chapter, ratio analysis. So there we have a activity ratios. Yeah. Activity ratio. Under that, debtor turnover ratio. What is annual credit sales? What is the formula? Annual credit sales divided by average accounts receivables. So account receivable includes both debtors and bills receivable. But in the question, they have given only debtor information. So all this informations we have calculated, we will straight away go with formula. So average debtors actually we have to calculate. So we have calculated opening and closing. So average debtors, that is 2 plus 1.2 whole divided by 2. It is 1.6 lakh. Okay. So credit sales is 9.6 lakh. 1.6. So 9.6 divided by 1.6. It is 6 times. My credit sales is 6 times of my average debtors. Clear? Yes. So here one important thing is this calculation. If you can manage this, yes, the other things are easy. Yeah, bit tricky question. Be careful. Next, using the information in question number 76, calculate average collection period. Average collection period means debt collection period. So it will be number of days in a year or number of months in a year divided by debtor turnover ratio. Debtor turnover ratio we already calculated 6 times. So let us take months. 12 months in a year divided by, as the options are given in 2, 3, 1, 4. So obviously it is understood that they are calculated in months. So 6 times is the debtor turnover ratio. So how much it will be? 2 months. Actually the answer is 2 months. But what they have given is 2 times. It is actually not times, 2 months. Yeah. If by chance, if the options, if they are given days, what you will do? You will do number of days in a year 365 divided by 6 times. You will get 365 divided by 6. That is 60 days. 60 or 61 days. Clear? You can round it up. Okay. Proprietary fund. Proprietary fund is also called shareholder fund. What it is? Equity share capital plus preference share capital plus reserves. Yes, partially correct. We will see. Equity plus preference. No. Equity plus preference plus reserve minus fictitious asset. This is most appropriate. This is most appropriate answer. Yes. Equity plus preference plus reserves plus fictitious. No, it is minus fictitious assets, which will appear on the asset side. Yeah, like goodwill written off, to be written off, all the items will come, or any discount on issue of debentures, preliminary expenses, all those things form part of fictitious assets. Or if P&L account is having any debit balance which is loss, that may come under fictitious assets. So this is what the proprietary fund, which is nothing but shareholder fund. Yeah. Match list 1 with items in list 2. Okay. So when they are given to match something like this, match one by one. Don't try to match everything at a time. Go one by one. We will also do that. All items on the statement are expressed as a percentage of base item. So there is one statement while analyzing the financial statement where we take one of the item as base. That is, in our P&L account, we will normally take sales as a base and we will convert all other values on that as a percentage. Whereas in balance sheet, we may take total assets or fixed assets as a base and we'll convert all of our items at using that as a percentage. So what do we call that as? What do we call that as, guys? Compare common size statement. We will call it as common size statement. Okay, so we will match it. What is that? A. We will write it A for this. We call that as common size statement. We will keep one item as common and we will try to convert all other items on that, or we will compare all other items on that. So as we keep one item common, we call it as common size statements. Next, index numbers of movements of various financial items in the financial statements for a number of periods. So for a number of years, for example, we will take sales. We will see what is the movement. Last year, how much it was. This year, how much it is. So we'll do comparison. Okay. So what we will do? We will see the trend there. Okay. For example, if you are doing the chart, what we will do? Sales. We will do the chart for sales. Okay. In 2015, how much it was? Assume this much. Then in 2016, how it was? It went like this. Okay. So there is a up movement. Then in 17, it went up. Then in 19, again up. Whereas in 2021, it would have come down due to COVID. Then again it went up. So here what you are doing? Trend analysis. Means you are seeing how is my sales moving from one year to another year. So that is trend analysis. Okay. Next, coming to a statement of source and application of funds. We call it as fund flow statement. Okay. So fund flow statements actually present the source and application of fund. So this is C, fund flow analysis or fund flow statement. Last, a study of different items of financial statement is called comparative statement, D. Yeah, so you have to see where it is matching. A, so it is for A, it is 2, so here. Then for B, it is 3 here. So the answer is C. You can check the other two also. The answer is C. So when you are doing or matching like this, match one by one, guys. Yeah, and try to match all four, because assume you're done with first one. So first one, even A option is having A 2 anta. Don't straight away choose that option only, because the next options, so next answers and all might be different. So please cross check all four and then only answer it. Next, which is not a form of reporting? Descriptive reporting, yes. Subjective reporting, there is nothing called subjective reporting. Then tabular reporting, graphic reporting, presentation. So subject reporting is not a form of reporting. Yeah, next. The following figures are available from the records of ABC Enterprises as at 31st March. What are those? Sales for 2 years, profit for 2 years is given, PV ratio. So here we have to use the second formula. For PV ratio, the formula is contribution by sales into 100. But here, 2 period data is given. What will you do? Change in profit divided by change in sales. So change in profit is 20. Change in sales is 50 into 100. So 20 by 50 into 100, 40%. 40% is the answer. Okay. Using the information from question number 81, the total fixed expenses is. So they are asking you to calculate the total fixed expenses. So take any one period. Let me take 2020. 2020. So sales is given 150. Sales is given 150. So into PV ratio, if I do sales into PV ratio, if I do, you will get what? Contribution. How much is that? 150 into 40%. 60 rupees or 60 lakhs, whatever. Yeah, 60 lakh. So contribution you got 60 lakh. So from contribution, if I reduce fixed cost, you get profit. So profit is already given 30. So now fixed cost, you find it out as a balancing figure. That is 60 minus 30. What will be your fixed cost? 30. Clear? So when you are calculating, what you will do? 60 minus 30. You will get the fixed cost as 30. Clear? Yes, 30 lakh is your fixed expenses. You can also take this year, you will get the same number. Next, using the information from question number 81, the break-even sales is. So fixed, so break-even sales, what is the formula? Fixed cost by PV ratio. Fixed cost we just now calculated 30 lakh by PV ratio 40%. So 30 lakh by 40%, 75 lakh. 75 lakh is the break-even sales. This is the point where we will recover all the cost, including variable and fixed cost. Using the information from question number 81, sales required to earn a profit of 90 lakh. That is, we are supposed to calculate required sales, which is nothing but contribution plus desired profit by PV ratio. Sorry, not contribution, fixed cost. Okay, which is nothing but fixed cost plus desired profit is nothing but contribution. Okay, so fixed cost is 30 lakh. Company wants to make 90 lakh profit, divided by PV ratio is 40%. So how much will you get? 120 divided by 40%, 300 lakh. 300 lakh is the answer. Yeah? Yes. Next, we'll go to the next question. Using the information from question number 81, profit or loss that would arise if the sales were 280 lakh. Okay. So if sales is 280 lakh, what is contribution? Straight away we'll go to contribution, 280 into 40%. And what is variable cost? 60%. Okay, I'm straight away doing contribution. So 280 into 40%, 112, minus fixed cost will anyway remain fixed. How much is that? 30 lakh. So how much will be your profit? 112 minus 30, 82. 82 lakh. 82 lakh will be the profit. Clear? Yes. And PV ratio is nothing but how much is your contribution when compared to sales. If PV ratio is 40%, how much will be variable cost compared to sales? 60%. Okay, straight away you can do sales minus variable cost minus fixed cost also. I've straight away done with contribution. Anyway, we know the PV ratio now. Straight away you can go to that step. Yeah. Let us go to the 86th question. Match list 1 with items in list 2. Again, matching. So do one by one. Facility level. So here they are trying to ask you different level and what is the cost pool for it. Facility level. So for facility level, what is it? What is the cost pool? It is human resources. So A, which is nothing but service related. Correct now? Yes. Next, product level. So on what will you perform product level activities? On what you will mention or do product level activities. That is for each and every product you perform these activities. So what is it? It is parts management. That is for each and every product you require different parts for which you have to perform different activities, which are called product level activities. Then batch level normally happens for purchase, because when you are purchasing and all, you will not purchase 1 or 2 items. You will purchase it in a lot, in batches of 1000 units or 10,000 kgs, 20,000 kgs, like that. So this is C. Then unit level, that is when you are doing quality control or inspection test. So that is D. So here for A it is 3, yes. Then for B it is 4, yes, parts management. Then for C it is 1, that is purchasing. For D it is 2. The answer is D. Yeah, so first try to mark like this, like how I am doing in pencil. Okay, you can just write it in small in your question paper only. Then once you are done with this answer, you just erase it to be on safer side. Okay, or else simply some invigilators may also trouble you if you are writing anything on question paper. So if by chance if you are writing anything, just write and immediately erase it once you are done with that question. Yeah, chalo. A Limited invested 500 lakh in assets. There are 50 lakh shares outstanding. The par value of the share is 10. It earns a rate of 15% on its investment, which is nothing but R. This is R, small r. And has a policy of retaining 60% of earning. Growth rate is. So growth rate means what will you do, guys? G is equal to B into R. R is directly given, which is 15%. Let us calculate B, retention ratio. B is nothing but retention ratio. A company has a policy of retaining 60% of their earning. So what is retention ratio? 0.6. What is R? 0.15. Means how much the company would be earning. So 0.6 into 0.15, it is 0.09 or 9% if you multiply with 100. Clear? So they have given other story and all, company has invested, they have so much of shares and all, which is not relevant for the question what they have asked. Yeah. Now let us go to the next question. 88th question. D Limited has the following details. Return on equity 10%. Expected earnings per share. Expected earnings per share means EPS 1. Yeah. Return on equity 10%. So it is nothing but R. Payout ratio. Payout ratio means dividend payout ratio 30%. Required rate of return 5% per annum. This is nothing but K. Price of a share of D Limited is. So if you are calculating P naught, it will be D1 divided by K minus G, as there is growth rate and all. So expected earnings per share is 10 rupees. Payout ratio is 30%. So can I calculate D1? How is it? That is D1 will be 10 rupees, which is EPS, into payout ratio 30%, which is 3 rupees. Which is 3 rupees. Okay. 3 divided by K is how much? 0.05, which is required rate of return. G is return on equity. That is return on equity. R they have given. G we have to calculate. It is not given. Return on equity R. Retention ratio will be 70%. When payout ratio is 30%, retention ratio will be 70. So let me calculate G also, which is B into R. Retention ratio, as I told you guys, dividend payout ratio is 30%. So the remaining balance would be retention ratio, which is 0.7. On that, the company is earning how much? 10%. 0.10. So 0.7 into 0.10, you will get 0.07 or 7%. 7%. So here it will be 0.07. Actually, this question is not correct. Why? Because you cannot have negative. That is K minus G when you are doing, you are getting negative. That is, actually you have to do 3 by minus 0.02, which is not correct. Always you should have this figure positive. So 88th question, just let us see what they have given in the suggested answer. 88th. Yeah, 88th, you can see they have marked star. What is it? None of the option is correct. Correct answer is 46.15. Actually, that is also not correct. Why? Because the given information itself is not correct. Because you cannot get K minus G negative, guys. Clear? Yes. So even if by chance, okay sir, let us do it. So for example, 3 by 0.02, if you do, what you will get? Actually, you are getting 150. You are getting 150 rupees. Is that there in the option? No. 150 is not there in the option. So this question is not correct. So what institute has given the disclosure is, if there is any question which is not correct or which is incomplete, or if any of the options are not correct, then whether the student has attempted it or not, they will get grace marks. Means in simple, every student get the grace marks whenever the question is not correct or incomplete. Clear? Yes. So one of the example is in management accounting, 88th question. Yeah. Let us go to the next question, 89th. An increase in earnings per share or a reduction in loss per share resulting from assumption that convertible instruments are converted, that options are warranted or exercised, or that ordinary shares are issued upon the satisfaction of a specified condition is called anti-diluted earnings per share. Clear? See, what is this is? See, normally we calculate earnings per share, which is earnings available to equity shareholders divided by number of equity shares. Earnings available to equity shareholders divided by number of equity shares. But sometimes what company do is, if there is any convertible debentures or convertible preference shares which will be converted into equity shares in the future, they will add that also. Okay, we know that we will be converting this in this debentures or preference shares in the future to equity shares. So for number of equity shares, they will also add, we call this as potential equity shares. Means in the future it will be converted into equity shares. So assume there are 10,000 convertible debentures which will be converted into equity shares after 1 year or 2 years. How many equity shares? Assume 10,000. So we will add this 10,000 also as what? Potential equity shares. Okay. So now assume you have got normal calculation, but by normal calculation you have got EPS 100 rupees. By doing this, normally the EPS will go down. So assume by doing this calculation you have got EPS 90 rupees. What do we call it as? When it goes down, we call it as diluted earnings per share. Diluted earnings per share. Okay. Sir, what if it increases? Assume when we do this calculation, even considering the convertible debentures or convertible preference shares, assume the EPS went up to 105. So there is an increase in EPS by 5 rupees. What do we call it as? Anti-diluted earnings per share. Normally we always calculate EPS by considering what is the existing number of equity shares. That is earnings available to equity shareholders divided by number of equity shares. Agree? We will calculate this EPS only when we are considering the potential equity shares. That is, if any debentures or preference shares to be converted into equity shares in the future, we consider that also. So due to that, if there is any increase in EPS, we call it as anti-diluted EPS. If there is any decrease in EPS, we call it as diluted EPS. Yeah? Yes. Chalo. So here they have clearly given increase in earnings per share. Okay, so the answer is anti-diluted. If there is a decrease means it is diluted. Okay. Following are the objectives of to determine fair value, to set out a single Ind AS framework for measuring fair value, to require disclosure with respect to fair value measurement, financial instrument presentation. Okay, so they have given three objectives. What it is an objective of what? Financial instrument presentation, market based approach, principal market measurement, or fair value measurement. The answer is fair value measurement. This is a separate Ind AS is there on this. Clear? So if you just see the options only, you can see everywhere they are talking about fair value, fair value, fair value. That just by seeing that only you can decide it is a objectives of what? Fair value measurement. Yes. Next, coming to 91st question. When a business is non-operating or has been generating loss, means simple, they don't have income, and the company focus is holding investment or real estate, which method of valuation is best used in the case? Which method you will use? Asset approach. Asset approach, because you cannot use earning based approach or discounted cash flow method. Why? Because you are not generating any income or cash flows. So obviously, which is the best suited method? Asset method. Okay, next question. 92nd. ABC Limited has 50 lakh in long-term debts, 10 lakh in preferred stock, means preference stock, preference share capital, we will call it as, and 40 lakh in equity, common equity, means equity share capital. Okay. All the values are on market value. So whatever values they have given is on market value. The before tax cost of debt is 10%, cost of preferred stock is 11%, and cost of common equity is 15%. Assume the tax rate as 40%. The overall cost of capital, means you are supposed to calculate overall cost of capital, which we also call it as weighted average cost of capital. Let us try to do it in the form of table. You can also do it as an equation. Let me do it as source of capital is debt, preference share capital, equity share capital. Okay. Amount we will do. Amount is debt is 50 lakh. Yes. 50 lakh. Preference share capital 10 lakh and equity is 40 lakh. 10 lakh, 40 lakh. So the total is 100 lakh. Okay. Next, let us just calculate the weight. 50 by 100, 0.5. 10 by 100, 0.1. 40 by 100, 0.4. Hope you understood how to calculate. This is the weight of debt, preference share capital and preference equity share capital. Next, cost. Cost they have only given. For debt, we should always take cost after tax. 10% is before tax. So tax is 40%. So do 10 into 1 minus tax percent, that is 0.4. So if you do 10 into 0.4, you will get 6%. So what is the cost of debt after tax? 6%. So this is 6, preference share capital 11, 11 and equity 15. So 11, 15. So multiply this two. Multiply this two. So 6 into 0.5, 3, 0.1 into 11, 1.1, then 0.4 into 15, 6. So do M plus. Means I have used M plus here, so you guys can also use it. So what is the overall cost of capital or WACC? 10.1%. Yeah, yes. So is it given in the option? Option only is not there. Actual answer what we get is 10.1%, which is not there in the option itself. So what is the suggested answer they have given? Just we will see which question is that. 92nd. Yeah, 92nd star mark. That means none of the option is correct. Correct answer is 10.10. Yeah, or 10.1. Yes. So that means you would be getting grace marks for this kind of questions. Yeah. Next, gas, oil and company has two divisions, transportation and refining. Transportation division sells crude oil to refining division Okay, transportation division is selling crude oil to refining division. The cost of 1 barrel of crude is 50. Direct labor is 15 plus variable overhead is 3 plus fixed overhead is 35. Transportation division sets its profit margin 20% of variable cost. If transportation division is operating at full capacity, the transfer price will be okay. So whatever is their variable cost, they are fixing 20% profit on it. So what should be the transfer price? Simple. So add up the variable cost, 50 plus 15 plus 3, 68 it will be, plus 20%. This is profit. And obviously fixed cost is also cost for us. We have to add it, plus 35. So it will be 116.6. 116.6. See, profit it is added on variable cost. That doesn't mean that they are only charging variable cost. It is variable cost plus fixed cost plus profit. So variable cost you add up. Okay. Add 20% for it plus fixed cost, which is 35. So that will give you 106.6, which is nothing but transfer price here. Yeah. Next question. Achieve goal congruence, realistic performance evaluation, and maintain autonomy of divisions are the objectives met by which method of transfer pricing? Cost-based transfer pricing? No. Negotiated? No. Market-priced? Yes. Market-based transfer pricing. So these are the objectives which are met by the market-based transfer pricing method. Yeah. Let us go to the next question. If profit is 20,000, break-even sales is 2 lakh, PV ratio is 40%, what will be the margin of safety? MES they have asked. Margin of safety. Profit they have given 20,000. Break-even sales they have given 2 lakh. PV ratio 40%. What will be the margin of safety in rupees we have to calculate? Okay. So profit is 20,000. So we know that for margin of safety, profit will be equal to contribution, and profit we get only for margin of safety, because until break-even sales we never achieve the profit, because at break-even point the cost will be equal to my total sales. Yes sir. So how we have to start? Profit. Okay, let's just start with profit. 20,000 by 40% we do. Just a second. 20,000 by 40%. 50,000. Okay, just a second. Let us better go this way. Okay, break-even sales. Break-even sales is given, which is the formula is fixed cost by PV ratio. So break-even sales is 2 lakh. Fixed cost, let us calculate now. Break-even sales is 40%. Now, so do 2 lakh into 40%, which is 80,000. So fixed cost would be 80,000. Okay, fixed cost is 80,000. Next, what they have asked is margin of safety. Fixed cost is 80. Just a second. Yeah. Chalo. Now we'll go reverse way. That is, we know sales minus variable cost is my contribution. Contribution minus fixed cost is my profit. And they have given profit is 20,000. Fixed cost we just now calculated 80,000. So how much will be my contribution? Obviously 1 lakh. Reverse calculation. Reverse calculation, guys. How did I do it? Simple. 20,000 after 20,000 plus 80 means when we are going reverse, minus will become plus. So 20 plus 80 will be 1 lakh. Or else you can cross check. 1 lakh minus 80 is 20 na? Yes sir. So contribution is 1 lakh. So it is how much? PV ratio 40%. So can I get sales now? Yes. So sales will be contribution, which is 1 lakh by PV ratio, because PV ratio is nothing but contribution ratio 40%. So 1 lakh, 1 lakh by 40%, 2,50,000, 2,50,000. Okay, so sales, that is total sales is 2,50,000. Hope you guys understood, because PV ratio is, the formula is contribution by sales into 100 na. So nothing but it is how much of sales. So we add it 40%. We know contribution in rupees 1 lakh. I divide it by PV ratio, which is nothing but contribution to sales. What did you get? Total sales. Now we know margin of safety is equal to total sales minus break-even sales. Total sales is 2.5 lakh. Break-even sales is 2 lakh. So 0.5 lakh is my margin of safety, or 50,000. Because always we know margin of safety is total sales minus break-even sales. So 50,000 is the answer. Yeah. Nice. Actually, question is only one liner, but it is interesting, challenging. Chalo, we'll go ahead. 96th question. A firm has a total capital investment of 2,25,000. The firm earned a net profit during the last 4 years, 30, 40, 60, 50. The fair return on the net capital earned, this is nothing but NRR. The super profit is, so calculate first normal profit. Normal profit is 2,25,000 into NRR is 15%. So this is what you are expected to earn. But actually, what is your average profit? Average profit, let us add it, 35,000 plus 40,000 plus 60 plus 50, that is 110 by 4. So average profit is 46,250. This is nothing but future maintainable profit, also we call it as. This is what actually the company has earned, 46,250 on an average per year. Minus, what is the normal profit? 33,750. So that is your super profit, 12,500. Super profit, what is the formula? Average profit, or also we call it as future maintainable profit minus normal profit. Normal profit is nothing but capital employed into NRR, which is 15%. Yeah, so the answer is 12,500. Next, 97th question. Which is not an approach for valuation of intangible assets? Cost approach, yes it is. Super value approach, there is nothing called super value approach. Market value approach is there. Economic value approach is there. So which is not an approach for valuing the intangible asset is super value approach. Okay, next let us move ahead. 98th question. The date on which the company and employees agree to the terms of employee share-based payment plan is called what? Grant date. This is the date on which not grant, it is grant date. It should be T. It is grant date on which both the parties will agree for the terms. Okay. Next, 99th question. The relevant details of the company are equity share capital 25 lakh, face value of the share is 100, profit for equity shareholders, that is earnings available to equity shareholders is 5,15,000, dividend payout ratio is 40%, P ratio is 30. Calculate earnings per share. To calculate earnings per share, some irrelevant information and all is given. Okay, earnings available to equity shareholders is how much? 5,15,000. Divide it by number of equity shares. Number of equity shares is 25 lakh equity share capital divided by face value, which is 100. So it is 25,000. 25,000 number of equity shares are there. So 5,15,000 divided by 25,000, you will get 20.6. So earnings per share is 20.6. Some irrelevant information, dividend payout ratio, P ratio and all they are given just to confuse the students. Yeah, last question. Equity share capital 25 lakh, face value 100 rupees, same story. Profit for equity shareholders 5,15,000, same story. Dividend payout ratio 40%, P ratio 30. Okay. Now we want dividend declared by the company. How much is the dividend declared by the company, guys? 5,15,000 is the earnings available to equity shareholders. Out of that, dividend payout ratio is 40%. So this is what they have declared it as dividend. So how much is that? 5,15,000 into 40%. 2,06,000. Divide it by number of equity shares. 25,000. 25,000. Yes. So divided by 25,000, it is 8.24. 8.24. So please be careful. Dividend payout ratio means out of your earnings, how much is paid. Don't straight away take 100 into 40%, 4 rupees anta. That is not correct. Sorry, 40 rupees anta. That is not correct. Please be careful. Fine, guys. Yes. So we are done with the discussion of this question paper. Hope this session was useful for you. All the best. Study well, guys. Bye-bye.